time value of money is the single most fundamental concept in finance and investment valuation. It applies to valuation of all investments, from treasury bills to common stock to capital spending projects. You will rely heavily on this concept in discounted cash flow analysis for capital budgeting, determining the IRR of bond cash flows, using the dividend discount model for equity valuation, evaluating working capital tools regarding credit policy or vendor payable terms. So how do you feel about this concept? Hopefully, you've done some reading from the text and have a general idea about what's behind time value of money. Think about where you fall on this spectrum as we get started. Mentally put a check mark somewhere on this page. Most students come into this with some trepidation. Don't worry about that. We will go through enough examples, enough discussions in class and in this presentation to get you comfortable. Most of the decisions we face in finance center on evaluating cash flows at different times. What we will soon learn is that cash received at different times, now versus later, has different value depending upon when it was received. A dollar of cash flow received today is not equal to a dollar of cash flow received in the future. So if we don't have a mechanism to make the value of a dollar of cash flow consistent across time, we would be comparing apples and oranges. The mathematical relationship, this idea of time value of money, that we will define next is just a technique that we use to convert oranges, a dollar received at some point in the future, to apples, a dollar received today. As I said, many students are apprehensive about the math involved in this portion of finance in particular. You're going to see a lot of algebra on the following pages. Be calm, keep calm. I'll walk you through it. Let's start with a simple definition. Present value. What do I mean by that? The present value is the amount of cash flow I receive at a specific time, generally now. But maybe we're going to receive the cash flow at some time in the future, and that's the only value that we know. We can calculate present value by multiplying the amount of cash flow that I will receive in the future by some factor. Here's the algebraic formulation of that statement. We read this as the present value at time 0 is equal to the future value at time t multiplied by a factor of the variables time and rate. Let's eliminate some of the algebra for just a moment to work through a simple example. If you placed $1,000 in a bank deposit that will pay you 5% for 1 year, after 1 year, how much would you have? Well, you would get back your initial principal, the $1,000, and the interest that you earned on that principal, $50. You would have $1,050 in the bank account. In the context of our present value and future value definitions, the 1,000 deposited is the present value, PV at time 0. And the 1,050 in the account is the future value at time t. Let's substitute those amounts into our equation, and then rewriting that equation to solve for the discount factor by dividing both sides by 1,050, or the future value sub t. That gives us the result 0.9524. Since the present value will always be a smaller number than the future value, in theory at least, the discount factor will always be less than 1. Remember, it takes fewer dollars today to be equal to an amount received in the future. The discount factor represents the value today of $1 to be received at some point in the future. Let's turn things around now and use what we calculated here to see another example of time value of money. Suppose you know you're going on vacation next year and you will need $1,000 for the trip. How much do you need to save today, a present value, so that you have $1,000 a year from now, a future value? Let's plug our variables into the equation. $1,000 is our future value, and we know the discount factor, 0.9524, that relates to a 5% interest rate and a time period of 1 year. We can calculate the present value as $952.40. That means we need to save $952.40 today, the present value, to have $1,000, the future value, in 1 year, the time t. And if our interest rate is 5%, the R. Now let's use these same concepts and get a little more rigorous. Let's begin by defining more specifically what we mean by future value. If you have an amount of money today and invest it at a specific interest rate for a specific period of time, you understand that it will grow to some higher value in the future. Conceptually, the amount you have today is the present value at time 0. We will compound that present value. That is, we will add something to it by an amount that is related to the number of periods in the future that we are investing for until time t, and the interest rate that is appropriate to that time period. The algebraic equation of this relationship is stated above. The future value at time t is equal to the present value at time 0 multiplied by the quantity 1 plus the interest rate raised to the nth power, where n is the number of periods. We can turn that relationship around now and define the present value. If you are to pay a specific amount of cash flow at some point in the future, you will want to know how much money you would need to invest today at a specific interest rate for that specific period of time, so that your investment will grow to equal the amount you have to pay. Conceptually, the amount you have to pay later is the future value at time t, which is n periods in the future. To determine the present value, we will discount, that is, we will subtract something from the future value at time t by an amount that is related to the number of periods in the future that we have to make the payment, that is, until time t, and the interest rate appropriate for that time period, r sub t. The algebraic equation of this relationship is here. To calculate a present value at time 0, we multiply the future value at time t by the reciprocal of the quantity 1 plus the rate raised to the nth power, where n is the number of periods in the future. Alternatively, we can just see that as dividing the future value by that 1 plus r raised to the n. If the algebraic appearance of these relationships causes you to break out into a sweat, you don't have to worry about it. Interestingly, historically, finance textbooks have put pages and pages of tables in the back of the textbook calculating 1 plus r time t raised to the nth power for a variety of r's and n's, and printed those in the textbook. Today, there are any number of excellent present value calculator apps available for a smartphone or a tablet. And Excel has these functions built in and available. There are any number of excellent present value calculator apps available for a smartphone or a tablet. And Excel has these functions available. They all work on the same concept. If you know 3 of the 4 variables, present value at time 0, future value at time t, interest rate, or number of periods, the calculator will do the work of the equations above and give you the 4th variable. So if you know the future value of a cash flow, when in time it will occur, and what is the correct interest rate, then the app or Excel will give you the present value. But it is important to understand what the calculator is doing. It's solving these important equations here. So if you're mathematically inclined, this page will give you the algebraic derivation of what we just discussed on the previous page. Honestly, if you understand the concept of present value and future value being related by a factor of the interest rate and the time period, don't worry about this information here. Similar to the last slide, this just continues the algebraic derivation of the present value and future value relationship for any number of periods greater than 1. Again, the derivation is not important for your purposes, just the end result, that idea that the present value and future value are related by the interest rate and the number of periods. We will use that concept over and over again and again and again throughout the course. Just a word here on the concept of compounding. When used in finance, that means that at the end of the compounding period, the interest earned, or the amount due, is calculated and added to the principal value upon which the next period's calculations are based. Again, think of a bank savings account that deposits the interest earned for the month into the account on the last day of the month. Next month's interest earned will be a small bit higher, since the balance in the account is a small bit higher. We say interest compounds at a certain frequency, such as annually or monthly or even daily. That frequency is the units of our number of periods in these equations. Mostly we have talked or will talk about annual compounding. And if it's not stated or not mentioned anywhere, you can assume annual compounding. That implies at the end of each year, the interest calculation is added to the present value at the beginning of the year, and that sum becomes the present value at the beginning of the new year. When we use annual compounding, clearly an annual interest rate is appropriate. But of course, the frequency or compounding period could be daily or monthly or sometimes semi-annually. In those cases, we have to be careful that the interest rate used, R sub t, is stated in the same frequency as the compounding periods. So if we want monthly compounding, then we must use the monthly interest rate. The next slide works through this concept. This ugly looking equation is just a more general form of the present value equation. And again, you don't need to memorize or know that formula, right? The calculators will always do it for you. But what it tells us is that if we are using quarterly compounding, then M is equal to 4. And we divide our annual interest rate by 4. If the time period is 3 years with quarterly compounding, then we have 3 times 4, or 12 periods. Monthly would set M equal to 12, and for daily compounding, M is 365, although in many equations, we will round that off to 360. The shorter the compounding frequency, the faster money is added to your account, and the larger your investment value will grow for a given stated annual rate. Try that for $1,000 invested for 2 years at 6%, with compounding first annually, then monthly, then daily. Yes, try that. Pause the video here and calculate the value of $1,000 invested for 2 years at 6%, first compounded annually, then compounded monthly, then compounded daily. I'll be here when you get back. Okay, welcome back. Your results should be $1,123.60, $1,127.16, and $1,127.48. Just a little fun historical fact here. When banks faced interest rate caps on what they could pay on deposits, this was in the 70s and the 80s, stated in terms of the annual rate, they began competing to attract deposits by offering shorter and shorter compounding frequencies. Finally, someone decided to offer what was called continuous compounding. That means they broke each day not into hours or even minutes to compound your deposit, but into an infinite number of small periods. Since you can't divide an annual interest rate by infinity, or the formula above breaks down, the banks had to go to a higher level of math. The equation becomes PV is equal to the future value times e to the negative RT power. That term e refers to the exponential function and is equal to approximately 2.7182818 approximately. For our example above, of a 2-year time period and a 6% interest rate, the $1,000 deposit would grow to $1,127.50. Not a huge difference over daily compounding. But once one bank in the 70s with a very good computer started using it, everyone had to follow. Now that we have derived this idea of a discount or compound factor that is based on an interest rate, you can see that interest rates are quite important in finance. We will spend more time later talking about what an interest rate is exactly, but some interest rate enters into every time value of money calculation. And the time value of money enters into almost every finance decision. When we're discussing an appropriate interest rate for a decision, it is always this interest rate in the time value of money calculation that we have just derived. Just to make students crazy, sometimes we may call it a discount rate. When we discuss capital budgeting, we may call it a hurdle rate or the opportunity cost of capital. When discussing security valuation, it is often called yield or the required rate of return. Whatever we call it, we're always referring to that R sub T in these equations. So what is R? Well, R is an interest rate. And an interest rate is the compensation an investor earns for taking on risk. Again, much more on that later in the course. Interest rates aggregate together all the risks that an investor takes. The more risk you take, the higher the interest rate you will earn, or the riskier the cash flows, the higher the interest rate you need to use to discount those cash flows. What do we mean by aggregating all of those risks? Every interest rate basically begins with a risk-free rate. The risk-free rate is what somebody is compensated for in economic terms for deferring consumption. That is, do they need or don't need the money? The more people that need money right now or have great investment opportunities and want to borrow, right, the more people need money, the higher that risk-free rate will be. The more they need to be compensated for deferring consumption. To that risk-free rate, then, we'll add a bunch of premiums, a maturity premium. How long will it be until I get the money? Presumably, you will need a higher rate to lend for a longer period of time. What about inflation? What will the money be worth when I get it back? The higher the expected inflation, the higher the interest rate. How about credit risk? What's the probability that I might not get my money back? And if I have to try to get it back early, what is the cost of collecting it? What's the transaction cost perhaps involved? We all know we can trade stocks today for pennies, right? The transaction cost. But if you tried to flip a car, buy it today and try to sell it tomorrow, you'd find that transaction cost is pretty high. Same in real estate. Flipping a house doesn't work too well when you've got to pay a 5 or 6% commission to a salesperson. Another risk is, will I get the actual amount promised when it was promised to me? How about, can my investment be completely wiped out? Right? If I'm lending, I have some contractual agreements to get my money back and some enforceable agreements. But if I'm investing in stock, the potential could be that it would be completely wiped out. What if I'm investing in a currency other than my nominal or local currency? What will that currency be worth? Is there something unusual about this investment? What are the unknown unknowns? What are the things that I don't know? All of those uncertainties, all of those risks need to be reflected in the interest rate that we use in finance. So far, we've only talked about single cash flows. That is, we wanted to know what an initial deposit in the bank would grow to at one specific date in the future, or what one cash flow received one time in the future would be worth today. Interesting, but most investments, though, involve multiple cash flows that occur at different points in time over varying lengths of time. A bond, for example, pays interest every 6 months, generally, until its maturity, and then pays one last interest payment and returns the invested principal. So a 3-year bond that pays twice a year has 6 cash flows. A company may be evaluating an investment in a new manufacturing facility that will produce X million dollar widgets a month, which the company sells for $3, thereby producing gross cash flow of $3 million a month for however long the company can operate the facility and sell its widgets. Fortunately, if we want to know, and we generally do, the present value of a series of cash flows, we can calculate the present value of each individual cash flow and then sum them up. That is, the present value of an investment that generates cash flows in future periods is the sum of the discounted future values of each of those individual cash flows. Algebraically, that looks like this. We say that, again, the present value of a series of cash flows is each individual cash flow occurring at different points in time. Right? The present value is the sum of the discounted present values of each of those cash flows. And that's what this out here says. This says sum the cash flows divided by 1 plus r to the t over the time period 1 to n, right? The number of periods. That's simply the algebraic expression of the words there. The present value of an investment that generates cash flows in future periods is the sum of the discounted future values of those cash flows. Clear as mud, right? Let's look at an example. Assume a project has these forecasted cash flows for the next 5 years. We can use discounted cash flow to determine the present value of those 5 cash flows. And in fact, we need to use discounted cash flow or time value of money. We can't add up the cash flows that occur at different points in time because $1 received today is not equal to $1 received tomorrow. The dollars involved aren't all equal value. Some are oranges, some are plums, some are bananas, some are peaches, some are kumquats. And none of them are apples received today. In order to understand how much those cash flows are worth today, we have to use our time value of money concept and convert all the future values to present values. Since we know that the present value of a stream of cash flows, in this case, the present value of receiving $25,000 a year from now, $23,000 2 years from now, $30,000 3 years from now, $33,000 4 years from now, and $45,000 5 years from now. In order to understand how much those cash flows are worth today, we have to use our time value of money concept and convert all of those future dollars to present values. Since we know the present value of a stream of cash flows is equal to the sum of the present value of each cash flow, we can then add up the present values. We're going to assume here that our interest rate is 9%. If we discount that first cash flow, $25,000, by dividing 1 plus the interest rate, 9%, raised to the first power, we get $22,936. If we do that respective calculation for each of the 5 years' cash flows, you have converted each cash flow to apples, to a present value today. And you can now add them up reliably. You can do that. If you do that, you will see that the present value of these forecasted cash flows is $118,085. The future value today of receiving those cash flows totaling $156,000 in the future is $118,085. We'll spend a lot more time on this specific example and on discounted cash flow analysis in particular in the coming classes. You can imagine if you were doing an analysis of monthly cash flows for a project that went on for multiple years. When I was working for an insurance company, we issued a 100-year bond that paid interest quarterly, right? 4 times a year, right? That'd be 400 cash flows. A traditional mortgage is a 30-year, right? 360 monthly payments. That's a lot of cash flows to calculate the present values of, even with today's computing power. But fortunately, cash flows in an analysis often fall into some special categories, and we use simplifications to ease the calculations of those present values. Even if the cash flows don't fall exactly into one of the special cases, we might use that special case as an approximation. We'll see that a lot when we talk about investment valuation. So let's look at some simplifications, and then we'll discuss each one in particular. The first is what we call a perpetuity. A perpetuity is a constant stream of cash flows that lasts forever. A growing perpetuity, on the other hand, is a stream of cash flows that grows at a constant rate and lasts forever. An annuity is a stream of constant cash flows that lasts for just a fixed number of periods. And a growing annuity, again, is a stream of cash flows that grows at a constant rate but only for a fixed number of periods and then ends. We'll look at each of these now in order, and in class we'll go through some specific examples of each of them. For example, a perpetuity. Remember, I described that as a constant stream of cash flows that lasts forever. The payments never end. Suppose I promise to give you $1 a year forever. Not my lifetime, not your lifetime or our kids' or grandkids' lifetimes, but forever. I or my heirs would owe you or your heirs that $1 per year until time ended. How could we calculate the value today of that obligation of mine? Well, we know we have a stream of cash flows, and we know the present value of a stream of cash flows is the present value of each individual cash flow. So in this case, we would calculate the present value of the first cash flow, the first dollar I give you, then the present value of the second cash flow, and then the third, and so on until we run out of cash flows. Unfortunately, in this case, we would also run out of time because our calculations would never end. I think those cash flows go on forever. We have an infinite number of present values to calculate. It's not going to work. Fortunately, some very, very smart mathematicians somewhere in time determined that the sum of this series of calculations would simplify to the cash flow for each period divided by the discount rate. In other words, right, our cash flow for each period divided by the interest rate is the present value of a perpetuity, a stream of cash flows that lasts forever. Let's think again about my promise to pay you $1 forever. That would be worth $1 divided by an appropriate interest rate. Let's say it's 10%. $1 divided by 0.10 is $10. The value of my promise to pay you $1 a year forever would be worth $10 today. If I were you, I'd try to get that $10 from me right now. So if we know or believe we can approximate that a series of cash flows is expected to be constant and perpetual, we can easily calculate the present value of that stream of cash flows. A related simplification of a stream of cash flows is a growing perpetuity. In this case, the stream of cash flows begins with a set amount in the first period, and then every period that amount is increased by a constant percentage. So if instead of offering you $1 a year forever, I offered you $1 next year and agreed to increase my payment by 5% every year, I would owe you $1.05 in the second year, $1.10 in the third year, and then $1.16, $1.22, $1.28. While we can calculate the present value of this stream of payments as the sum of the individual present values, we have the same problem of this series going on to infinity and beyond. Once again, the mathematicians bail us out, and this infinite series simplifies to the present value being equal to that initial cash flow, $1, divided by the difference between the discount rate and the growth rate. Now, don't ask right now what happens if the growth rate is greater than the discount rate. Just don't ask. Going back to my promise to pay you $1, growing at 5% a year forever, if that correct discount rate is still 10%, the value now becomes $20. That is, it is $1 divided by 10% minus 5%, which is $20. We'll see a very useful application of this growing annuity when we look at the valuation of common stocks. So I'll hold off on any more examples until we get there. An annuity, remember, is a stream of constant cash flows. It's like a perpetuity, but now the stream ends at a stated point in time. Right? We get a specific cash flow, the same amount every year for each period for that stated number of periods. Like any stream of cash flows, we can calculate the present value of this stream of cash flows as the sum of the present values of each individual cash flow. Unlike the perpetuity, though, now our calculations end at a known point. If you have a small number of periods, you could calculate the present value of each cash flow, right? C, the cash flow, divided by 1 plus the interest rate raised to the first power, added up, right? Add that to the present value of the cash flow received in the second period, and then sum them all up. But if you had a very large number of cash flows, such as a 30-year mortgage again with monthly payments, that calculation would get tedious. The mathematicians again have some good news, not quite as good, in that the equation can be simplified, then that this calculation can be simplified to an equation. The equation's just not quite as simple as for a perpetuity. But as so long as you know the amount of that periodic cash flow, the number of periods, and the interest rate, you can plug those variables into an equation and calculate the present value. And again, Excel or a calculator app on your phone or tablet will do that calculation as well. The final simplification, if you can call it that, is a growing annuity. Like the growing perpetuity, this is a stream of cash flows that begins with a certain amount, and that amount is increased every period at a constant rate. Since it is an annuity, though, the cash flows last for only a certain period of time. They end after period N. Still, we can calculate the present value of this stream of payments as the sum of the individual present values, and the mathematicians have simplified this series into another equation that, again, looks very ugly. You don't have to know or memorize this formula. It does still just involve inputting the known variables. In this case, the initial cash flow, the growth rate of the cash flow, right? That is G in this case. The number of cash flows again, and our required rate of return. The result of that equation is the present value of a growing annuity. In class, we'll go through some examples. There's a very good one of this growing annuity, in fact, from the real world. So we'll go through examples of each of these: perpetuity, growing perpetuity, an annuity, and a growing annuity, to try to put some real world examples to these mathematical formulas. So, having been through this discussion, recognizing that haven't discussed it yet in class, how do you feel now about the time value of money? Has that mental check mark that you placed on this spectrum from anxious to got it, no worries, has that check mark moved?